As the conflict in the Strait of Hormuz escalates, gold has just given us a textbook lesson in deception. It surged past $5,404 an ounce on the initial headlines, only to reverse and collapse 3.5% in a single week, falling below 5,123. If you're sitting on a physical stack right now, watching this unfold and asking, why the hell isn't it pumping? You are not alone, but you are asking the wrong question. This is not a failure of gold. It is a live fire demonstration of a predictable pattern that the headlines are paid to ignore. What you are witnessing is not a breakdown of the safe haven narrative, but a live confirmation of how the deeper forces of money actually work. This analysis will arm you with the cold historical truth that proves your stack is right, but for reasons the market desperately wants you to forget. Because before we can dissect the delayed fiscal consequences of war, the shockwave that truly matters, we must first establish the bedrock principle that even the central banks themselves operate on. That bedrock principle is brutally simple. Gold has no counterparty risk. This is the non-negotiable truth we all stand on, even when the market's short-term noise becomes infuriating. Let's be clear. Every other asset in the modern financial system, a stock, a bond, even the currency in your bank account, is a promise, a liability on someone else's balance sheet. A promise from a company to perform, a government to pay, or a bank to remain solvent. Gold is different. It is an asset of last resort precisely because its value is not a promise. It sits entirely outside that fragile network of promises and liabilities. This is the line in the sand. It's the deep truth that separates those of us who are awake from a system built on faith in paper. And if you want proof, look at the actions of the smartest, most cynical money in the room. The central banks themselves. As of early 2024, they collectively hold nearly $4 trillion in physical gold. They aren't speculating. They are following the exact same logic we are. A Fessy Russell report confirms this, calling gold a neutral haven free from sovereign risk. They know what we know, so if our foundational belief is this solid, if the world's most powerful institutions are validating our strategy, then why does this truth seem to fail us in the opening moments of a geopolitical crisis? Why are we left with flawed predictions when the shooting starts? That is the critical question we must now dissect. The answer lies in a single, brutal truth. The common belief that war is an instant, reliable catalyst for gold is a dangerous myth. It is a narrative trap set for the unprepared. While everyone else is reacting to headlines, we are going to look at the merciless historical data. And the data tells a story of consistent disappointment. This isn't ancient history. This is a pattern written in the financial record. It happened in the Gulf War of 1990. After the invasion began and the market gained military clarity, gold's annual average price fell by 9.62%. It happened again with the 2003 Iraq invasion. The pattern repeated. It happened again during the 2022 Ukraine conflict. Gold surged above 2,000, yes, but gave back most of those gains, ending the first half of the year with only a 0.6% return, as the market's focus pivoted to the Fed's aggressive rate hikes. And it is happening right now with the recent Iran conflict. A headline-driven surge to $544, only to see a 3.5% drop in a week as a stronger US dollar and delayed rate cut bets took over the narrative. This is not a theory. It is a blueprint for failure if you are betting on the initial shock. Let's pause and step back. We've just seen the data from 3 major wars and a live fire exercise. Have you personally felt that frustration when headlines scream war, but the price tells a different story? Share which of these examples surprised you the most in the comments. So why does this happen? 2 cold, mechanical reasons that the headlines never mention. First, the dash for cash. In a true panic, institutions are forced to sell their liquid winners, including gold, to cover margin calls on their losing positions elsewhere. We saw this with surgical clarity after the 9/11 attacks. Gold initially dipped due to this liquidity-driven selling. It only began its real rally after the Federal Reserve injected massive liquidity into the system. Second, gold competes. Its primary competitor in a crisis is the US dollar. As the data from Bloomberg consistently shows, gold has a negative correlation with the US dollar index. A crisis that strengthens the dollar acts as a direct headwind against the gold price. So the initial fear spike is a mirage, a trap for retail. But if the opening salvo of a war is not the real trigger, then what is? If this immediate price action is a lie, where is the truth? The truth is found in understanding the delayed consequences, the second-order effects that unfold months and years later. It's a framework I call the Fiscal Echo Doctrine, and understanding it is the only thing that will separate you from the herd in the coming cycle. So, what is the Fiscal Echo Doctrine? Let's be precise. Think of a war as a deafening blast in a canyon. The initial sound is the headline, shock. It's startling, but it's temporary. The doctrine dictates that we ignore that noise. Instead, we analyze the echo that comes back off the canyon walls, because that echo tells you the true size and shape of the event. The echo is the government's response. This is the insider's playbook, broken into 3 steps. First, you ignore the initial emotional headline shock. It is noise designed to confuse the herd. Second, you track the fiscal response. You follow the money, the new budgets, the emergency spending bills, the soaring public debt figures. This is the first tangible echo. Third, you monitor the monetary echo that always follows. The central bank's actions, the inevitable inflation that erodes purchasing power, and the subsequent shifts in interest rate policy. The event is the noise. The fiscal and monetary response is the signal. This is why, as one analysis notes, gold's true relevance emerges later, as governments respond to the economic pressures those events create. It's not a guess, it's a mechanism. The IMF has directly linked sustained gold rallies to these exact periods of government debt accumulation and inflation shocks. The ultimate proof. The Vietnam War. The unprecedented spending didn't cause an immediate gold spike. It caused the collapse of the entire Bretton Woods system years later, severing the dollar's final link to gold and triggering its historic, multi-year surge in the 1970s. That is the doctrine in action. But you must understand this. This fiscal echo, this predictable consequence inside our own economies, is now just one part of a much larger global game. Because what happens when multiple empires start printing to fund their conflicts all at once? The echoes combine. They create a monetary earthquake that threatens the foundation of the entire dollar system itself. And that is where the real endgame begins. And that endgame has a name: De-Dollarization. This isn't a slow academic drift. It's a violent acceleration forced by the West's own hand. Modern warfare is no longer just fought with munitions. It's fought with financial sanctions. The dollar itself has been weaponized. Let's be clear. When the US government freezes an adversary's dollar reserves, as it did with Russia, it sends a signal flare across the entire globe. Every central bank, friend or foe, witnesses the terrifying counterparty risk of holding dollars. This single act triggers an irreversible strategic pivot. This is the grand chessboard. While day traders are staring at price charts, central bankers are moving billion-dollar chess pieces. They are forced to flee the system and hoard the only truly neutral, sanction-proof reserve asset on the planet, physical gold. This is not a theory. These are the facts. Since the 2022 reserve freeze, central banks have been buying gold at record rates, over 1,000 metric tons every single year. The World Gold Council confirms that by early 2026, their total gold holdings, nearly $4 trillion worth, surpassed their holdings of US Treasuries for the first time in 3 decades. This is the hidden structural bull case the paper markets are desperately trying to ignore. Look at who is leading the charge. China, India, Poland, the entire BRICS alliance. 70% of central banks plan further increases. They are not asking for permission. They are diversifying for survival. This global pivot away from fiat and towards hard assets exposes one final unbreakable law of financial history. A mechanism that ensures once this process starts, it can never go backwards. It's a phenomenon I call the Ratchet Effect. And understanding it is the key to surviving the endgame. This process is governed by a mechanism, an iron law of history, documented with chilling precision by the economist Robert Higgs in Crisis and Leviathan, The Ratchet Effect. During a crisis, government power, spending and debt ratchet up. Crucially, they never return to their pre-crisis levels. Let's pause and look at the data. Before World War I, US federal outlays were around 3% of the economy. After, they never dropped below 5% again, establishing a new floor. After World War II, they set another higher floor near 15%. Each emergency creates permanent new taxes, permanent bureaucracies, and a permanently larger debt burden that becomes the baseline for the next crisis. Before you internalize this law, every geopolitical shock is a source of agonizing confusion. You watch gold stagnate and think the safe haven myth is failing again. You see paper games delaying the inevitable reset and ask yourself, why the hell isn't it pumping? But after you see the ratchet, every war becomes a predictable cold confirmation of long-term currency debasement. You are no longer guessing. You are observing a law of physics in motion. This is what locks an economy into a state of fiscal dominance. Let's be precise. Fiscal dominance is when a nation's debt is so large that fiscal policy, government spending, dictates monetary policy. The central bank loses its independence. It is cornered, forced to keep interest rates artificially low, and print currency simply to service the ever-expanding government debt. It becomes a logistical arm of the Treasury, not an independent actor. The same ratchet dynamic was at work after the Vietnam-era deficits. Those deficits and the monetary decisions they forced fueled gold's historic surge in the 1970s. Today, we are seeing the exact same pattern on a global scale. Analysts at institutions like Hoover and the AEA confirm that the post-2022 war spending has already locked in a new, irreversible floor for debt and structural inflation. So when you feel that internal torment over timing, the anxiety that your stacking has been for nothing, remember this law. The ratchet is not a theory. It is a historical constant. It proves that the relentless debasement of fiat currency is not a matter of if, but a mechanically guaranteed consequence of crisis. Your patience is not a gamble. It is a calculated, rational position based on the final verdict of history. So let's be clear.
The torment you felt watching the charts wasn't gold failing.
It was a failure of focus. Watching battlefield smoke, not the supply lines. The Fiscal Echo Doctrine means you now ignore the initial shock. You track the predictable aftermath, the debt, the spending, the fiscal bleed that always follows. You see de-dollarization for what it is. Central banks abandoning fiat to stack physical gold. You use the Ratchet Effect to see past temporary price drops, knowing long-term currency debasement is locked in. Your frustration is now replaced by cold conviction, the certainty of waiting for an inevitable outcome. While others react to the chaos of the headlines, you see the cold mechanics of the machine at work. So the next time headlines scream, "Why are?" and the charts look confused, you won't be. This framework provides the tactical patience required for the endgame. This is the deep structure the headlines are designed to hide. Subscribe to stay armed with the intel needed to survive.